Joining us now with more, Ethan Harris, Bank of America Securities Head of Global Economics. Ethan, is the U.S. going to make a mistake here? Lots of money pumped into the economy and then raising taxes?
Yeah, well, I think we have to keep the tax increase in perspective. What the Biden administration is proposing is a tax increase that would play out over a 15-year period, and they're matching that up against an infrastructure plan that plays out over 8 years. So if you look at just the next 8 years, the tax increase, even as proposed, assuming the whole thing goes through, is only half of the infrastructure spending. So the net, it's a pretty big stimulus to the economy. And remember, this is the proposal, and once moderate Democrats get involved, my guess is that they water down the tax increase.
So nevertheless, though, you are still seeing higher rates, market pricing in Fed rate hike more aggressively than the Fed's talking about. Do those act as a brake on the economy at all? And if so, when?
Well, I think right now you've got basically full speed ahead. There's no fluke in the recent data that you just described earlier. The fantastic ISM numbers, the fantastic payroll number, all of that stuff is being driven by reopening, massive fiscal stimulus that will continue on a forward basis, and a very slow motion Fed. No reaction by the Fed to the strong data. So I think that we've got a pretty much on-fire economy for well into next year. But then you get further out, and the Fed has to make a decision here. And they've been very unclear about what their end game is. What do you do if you're the Fed and you've already achieved a red-hot labor market and you're already getting a significant rise in inflation? What's your next step? And that's going to be a real challenge. So let's enjoy the next couple of years, but it could get rocky by 2023.
What do you think we're going to see in terms of productivity and wage hikes as this infrastructure kind of starts to work its way through the U.S. economy?
Well, on the wage front, it takes a little while to get wages heated up. I mean, you're still at an unemployment rate of 6%. If you look at the underemployment rate, which is a broader measure, that's still at about 10.5%. So there's room to bring more workers into the labor market without creating any real wage pressure. But as we go out, again, 2-3 years out, wages should really start picking up. And it's a combination of the stimulus package, but also just the general dramatic improvement in the jobs market. So it's going to take a while to get there.
So no doubt the goods economy, super strong. We see that with the ISM. We saw that with the jobs market, with the jobs number on Friday. The service economy is strong, but it could be stronger. What kind of upside gains should we be looking for, and how fast do we get there?
Well, I think the next few months you're going to see all of these numbers hit new records. You could easily get a payroll number as high as 2 million in a month going forward. You've got a long way to recover. We're still, more than 8 million jobs below where we started from. But you could see some months that really look off the charts. And for these purchase managers index as well, they're running in 65% of companies are saying things are improving. Well, that could go up to 70 or even higher. So this is the beginning of a run of very hot numbers. And I don't think it's fully priced in the markets either. I think there's still some upside surprises coming.
Where do you think we're not fully pricing it in? And that's my way of asking you, where should the 10-year yield be, for example?
Yeah, if you look at it, the market's pricing in a hot economy, but not as hot as what we're forecasting. So, for example, we have U.S. growth of 7% this year and 5.5% next year. The Bloomberg consensus is 5.7% this year and 4% next year. So you can see there's almost a 1.5% gap between our very bullish call and the consensus. And I think that is partly reflected in all of the markets. So there's still room for growth in the equity market. There's still room for upside on the dollar as the U.S. continues to outperform. And the 10-year yield, 10-year yields eventually should get up to around 3%. I don't think it happens overnight. But the move we've had so far just brings them to kind of, modest recovery levels. They need to price in something much stronger.
And Ethan, you guys were one of the bullish on the street on the jobs number, and you were right when it came to Friday. I guess the next question is, what did that do to the rest of the world? So the IMF managing director has said that while the outlook has improved, overall prospects are diverging dangerously. Vaccines are not available yet to everyone and everywhere. Too many people continue to face job losses and rising poverty. Too many countries are falling behind. Add that 3% 10-year, add that a stronger dollar. What does that do to the economic inequality in the world?
Yeah, well, I agree that this is a very troubling situation. I mean, as you move away from the U.S. and more into the emerging markets and then into the frontier economies, the outlook looks pretty bad. I mean, you have very slow vaccine rollouts, particularly in some of these economies that are not at the center of the global economy. You have, they can't do stimulus because the markets won't allow them to run the kind of budget deficits the U.S. is running. So they're in a tough bind. I don't think it's all bad news for them. I think the rise in U.S. bond yields is clearly not wanted around the world. It's putting pressure on them. They also don't want a strong dollar. Puts pressure on them to defend their own currency. But what they do benefit from is very high U.S. imports. So while it's a challenge to them, I don't think that the U.S. strength is the main issue for emerging markets. I think the main issue is that they've been so slow to get COVID relief, and they've already used aggressive policy tools to offset the COVID crisis, and they're really kind of out of ammunition. So it is troubling. I certainly share that. And the U.S. is putting a little extra pressure on them, but I don't think that's the central story.
But to that point, I mean, you're saying that there's going to be stronger demand coming from the U.S. How can the U.S. support the global economy like China did 10 years ago? Like, is that really going to happen? What does that look like? What does that kind of global recovery look like?
Well, I mean, China is also going to be supporting growth. So China has had a pretty quick recovery from the virus, but through their very effective tracing, tracking, and testing, tracing, and quarantining system. Obviously, they bungled things at the beginning, but then got on track. They're already relatively strong and will continue to grow above trend. So they're going to provide some stimulus in the global economy. And the main way that China helps is through commodity markets. So there's some benefit to commodity producers in emerging markets. The U.S. can be an engine of growth as well. It's mainly consumer and investment product demand, not nearly as much commodity markets. I think the concern would be for emerging markets is to what degree is the U.S. recovery service driven, and what degree is it domestic focused, right? So you have an infrastructure plan that's a Buy America plan. You have a reopening process that's mainly driving the service sector. So the spillovers or the coattails of the U.S. are modest, and that's why I think it is true that on net this is a challenge for emerging markets, even if the U.S. helps in some ways.